Hey warriors, I hope you're all doing great. This is your friend Rahul Agarwal and I'm here with the new video, an exciting one for all of you, the review of the May 2025 exams. Now, this is a small video being shot for reviewing the paper of CA Inter May 2025 direct taxes and also giving you my thoughts on what the final answer should be for all the things. We're going to be discussing on both the descriptive part of it and the MCQ part of it in the current video. But yes, before I start this video, let me give a small disclaimer. This video is not being shot with an intention to come and ask you to review your paper and see how much you're scoring. That's not the intention here. The intention is only twofold. One, for all my people who have done May 2025 and are a bit hazy on how your papers have gone, this would be a good sign for you to just quickly go through the answers on a high level to understand how much you will on a high level score. If you're at a position where you think, yes, you have done really well, this video is not for you. You will pass the CA Inter exams and we'll proceed with that. But if you are feeling a bit of haziness, where you feel like maybe the answers may not resemble what you're doing, it may be a good warning sign for you or an early sign for you to start preparing a little early for your September exams rather than waiting for your results. Second, this is a small video for all my September 25 and Jan 2026 students who are planning to write their exams coming forward. This will be a good sign for you to know how the paper pattern of ICI is so that you can plan your studies accordingly. Yes, with that one simple intention is what we're making this simple video. Here is not me coming and telling you about how you have performed and how you should be looking at your paper. If you have come with that mindset, I would request you to stop the video right away and go enjoy your life because you've gone through hell right now. It's not been an easy task, people, especially with the attempt and all getting indefinitely postponed and everything. I know you've put in a lot of efforts, so yes, you deserve the relaxation which you need. Take some time off and then start preparing for your upcoming exams if you have any, or let's hope that you are ready for your articleship as we proceed forward. For everyone who's continuing with the video along with me, let's look at this video and let's see how it goes. Now, if I'm giving you a very overview of what the paper looked like, I have certain thoughts. One, it wasn't very difficult, I would say. Yes, as compared to what September 2024 came in, this paper was definitely manageable. There was no challenges here. But to the certain extent, let me also admit to the fact that it was not very easy as well as compared to what Jan 2025 looked like. The paper for me was at a moderate level. Now, why am I saying it is at a moderate level? Because the paper fairly was easy. But upon my review of the answers which came up for things, I realized there are certain places where ICI has made blunders. There is a lot of errors in this paper which one person should be paying attention to. And so to that extent, if a student has spent too much time on a particular adjustment or a particular question, he may lose marks there. Yes, so to that extent, I feel the paper can be a little difficult or tricky for that matter. But other than that, the paper was definitely easy and a paper could have been easily scored. The good news which I heard from a lot of people, while I'm not sure about it, is that this time's GST paper as compared to the last two attempts were definitely easy. People were able to score a good amount of time and efforts in GST, and therefore you should be on an overall high level be able to score good marks as compared to what you have been getting in the past. Yes, but let me focus my attention to direct taxes and let's look at the paper. I'm going to be starting with the first leg of it, the MCQ part of the paper, and then we'll go into the descriptive part of it. Yes, your MCQ paper this time had two case study questions along with individual MCQs. So let's talk about the case studies first and then we'll go on to the MCQs. The first case study which I have. Now, if I'm reading this case study from an exam standpoint, I definitely am not reading at the case study. Let me look at the question and let's understand what the question wants from me and then I proceed forward with that. So the question number 1 says, they want you to determine the capital gains and the exemption which is available to Mr. Gopal for purchasing a residential plot considering the benefit of the assessee. 1 second. So the question is asking you for income from capital gains and the question is asking you for some exemption which is available to Mr. Gopal. So there is some capital gains and then there is an exemption. But the one thing which I'm paying attention to people, the question says they want exemption for purchasing residential plot. Now, in my understanding, there is no residential plot exemption as such in the whole income tax for capital gains. So to this extent itself, I can come and tell you there should be no exemption granted to you first of all. But let's read the MCQ so that we understand what is happening better. Question number 2 says they want you to compute the income from house property in the hands of Gopal. So they are going to give you some income and they want you to compute the house property income. Okay. The third says assuming Mr. Gopal has no income, they want the total tax liability of the person as well. So they want the tax liability. So in simple words, they want capital gains income, house property income, and then they want the tax liability of the question. Now, if my gut feeling goes right, capital gains, I'm assuming they're going to test you on the amendment. So let's see what is happening here. Look at the question. The question says there is a person called Mr. Gopal. Gopal is age 33 years and is a resident individual who's selling one of his residential houses for 60 lakh rupees on 31st August 2024. I think here is your hint. The sale has been made on 31st August 2024, which means this is after 23rd July. With this being after 23rd July, the property is eligible for the new regime and not for the old regime. Now, when I say regime, I'm meaning about the new benefits where it is no indexation rules. But this asset was purchased on 14/10/21. So now they are going to put you into trap. Notice the question. The question is making a sale after 23rd July, but the purchase was made before 23rd July, which means here comes in the amendment of the current year. The important amendment which we discussed on multiple occasions. When I put out the format for decodation of capital gains, when I put out the super 50 adjustments, also we discussed about it. And when I spoke about the important things to be read from exam perspective, also we spoke about it. When you have an immobile property which is sold after 23rd July but was purchased before 23rd July, when you compute tax alone, you need to compute the tax as per the old laws and the tax as per the new laws and find whichever is lower. Yes, so that is what is going to happen in this question, is what my gut feeling is. But nevertheless, the question says the purchase was made for 45 lakh rupees in 2021. Now, I think we are fairly done with the question number 1. We can answer the question number 1 right away. Because this is an asset which is sold after 23rd July, you are going to be falling in the new laws. The new laws would say just take the sale value, reduce the cost, and you'll get the capital gains. So 60 lakhs minus 45 lakhs is going to be my final answer, which means 15 lakhs is the right option. Now, even if I don't know the exemption, people, I think the easy answer will be fairly here. You know that the capital gains is only going to be 15 lakhs, which means option A is the only right answer here. Can you find any other option with matching 15 lakhs? No. Which means the answer will stick at 15 lakh rupees. So option A is the right answer. I am not even bothered about the exemption part. We'll read the MCQ and then we'll understand if there is something to be done of the exemption. But right now the answer sticks at option number A. Next. His old tenant has paid him a rent in arrears for the above said property on 12/11/2024 amounting to 75,000. Notice that I have received some arrears of rent and I have received it in the month of November after I sold the property in August. Now, just because I've sold the property in August, I am receiving the money in November does not change the fact that the income will still be taxable under IFHP, because when a rent is coming as arrears from the property, it is still taxable under IFHP even if you are not the owner of the asset. The money received by you is 75,000 rupees and that is going to be your arrears of rent. But for those who remember house property carefully, and this is what we have discussed in format as well, when you get an arrears of rent, you cannot just like that take 75,000 as a taxable component. You have to grant the 30% standard deduction. So which means if I take it, I will get 75,000 minus 30%. The number should come as 50,500. Yes, the number should come as 50,500. So till here, my answer should be 50,500 of taxable income from house property. Then he also purchased a residential plot on 8th December 24 for 5 lakh rupees, but no construction was started till date, although he earned 30,000 rupees as rent from this plot in the last quarter of previous year 24-25. So here is a question where they're coming and saying the person has not purchased a residential plot. I think this was ICA's attempt to make you confused on what will happen on the exemption part. Because they're using the word residential plot, people may come and say this is probably section 54. But notice, for section 54 to apply, there should be a residential house. A plot is not exactly an exemption and therefore this is not an exemption which can be granted to you, which means this is an irrelevant information. My question to answer number 1 stays at option number A. But the question is saying that the person has received some income from residential plot. Now notice, because there is no house, you cannot tax it under HP. This goes under IFOS. Yes, so this 30,000 rupees will go under IFOS and you can't grant any 30% standard deduction as well because this is taxable under OS. Mr. Gopal is opting for default tax regime under section 115 BAC is the question, which means the person is going for DTR. Now this is what the fact pattern is. I think I'm fairly done with question number 2 as well. The question number 2 wanted income from house property, not from other sources. So house property answer would be 52,500. House property answer would be 52,500. You will not be adding the 30,000 rupees worth of residential plot because that is not taxable under HP, that is taxable under IFOS. This brings me to the last question, where the question is asking for tax liability. Now, here is where you'll have to be a little smarter because the property of capital gains has been sold after 23rd July, so you have to compute both. To not waste any further time, I've actually already done the computation here. You will notice that as per the old laws and new laws, what will happen? If I follow the new laws, my IFOS income is going to stand at 30,000 rupees. I am going to have a IFHP of 52,500, which is what we just saw. And then you were taking a capital gains. 60 lakhs minus 45 lakhs without indexation. Therefore, the answer becomes 15 lakhs. My total income is 15,82,500. Now, here is what some people have to pay special attention to, and this is the next thing we discussed very carefully when we did the super 50 adjustments as well. Notice carefully that my slab rate incomes are only 82,500. and the person is opting for DTR, which means in a slab of 3 lakh rupees, I have only been exhausting 80 to 500 worth of slab incomes. When I have not exhausted my basic exemption limit, I am permitted to use my capital gains against for adjustments. And therefore, in this question, I would use my capital gains worth 2,17,500 as a part of my slab. So my slab now changes from 80 to 500 to 3 lakh rupees because I'm consuming 2,17,500 worth of capital gains. With that consumption already done, my capital gains will not be taxable to that extent, which means out of 15 lakh rupees, 2,17,500 has gone to the slab. The differential number is going to be taxed at 12.5%, which gives me 16,313. With my total tax liability becoming 16,313, if I add a cess on this, the answer comes as 166,730. Yes, yes. Let's move to the right side. If I am coming to a case where I'm saying, no, I want to do it as per the old laws because the transfer may be beneficial with indexation, my capital gains alone will change. My capital gains of 45 lakh rupees cost of acquisition will be multiplied with the indexation, which is given in the question already. The question says the capital gains indexations are 363 and 317. So I take the 363, 317. My cost becomes 515 to 997. My total taxable income for the year becomes 929,500. Now the same logic will apply in the 929,500. 80 to 500 is pertaining to slab income. So I will push some part of capital gains into the slab model. With me pushing that, I will now have a taxability at the rate of 20% because I am availing indexation benefits. Tax liability coming to 125901. With the cess, the number comes to 130940 after rounding off. Notice these two. If I am looking at these two items, my tax liability in my old scheme looks better, and therefore income tax will say pay tax as per 130940. Therefore, my final tax liability will become 130940. Let's check what the answer is. Yes, 130940 is my right answer. So 1,39,40 would be my right answer. Anything else will not match. Here is a small hint for you. If you have done the computation properly even under new scheme, you would have got the answer as 166,730, which is not part of the options itself, which means you can fairly sure be the fact that option A is the only right answer. Yes, this is your first MCQ. Now, in this, if a person has done things properly, your first and the second would have been answered. Probably you'll go wrong on the third one if you have not done the tax computation properly. If you have done the tax computation also properly, put in a word in the drop comment and say me that yes, I have done the thing properly after looking at the Super 50 adjustments. That is going to be a good win for you. Yes, this brings me to case scenario number 2. Now, I've had the liberty to go through case scenario number 2, and let me tell you this very honestly. One of the most wrong, useless and inaccurate questions given by ICAI. This is something which I'm very unhappy about, because a question like case scenario number 2 comes with multiple choices. This is a question which has multiple alternatives for a person to do, and any alternative can be treated as a right answer. For ICAI to come and give this as an MCQ question causes problems because you don't give an option to the students to give in their adjustments, their assumptions on the question. A question like this should not have been tested in exam, especially for an MCQ. A person with a right sound mind would have actually tried everything and therefore would have spent at least 1 hour to complete this question itself. I'll tell you why the 1 hour, because I've already done it. Let's read the question together and let's see what is happening. The first part of the question says they want the gross total income in the hands of Mr. Satya or whoever it is. Second question says they want the total income. So first they want you to find GTI, then they want you to find TI. And third thing says which of the following statements is correct in respect of losses to be carried forward. Yes, so they want some losses to be carried forward question to be answered for you. Let's look at the case study. The case study says there is a person called Mr. Satya and the person is a resident Indian. The person is opting for optional tax regime. So this is me going for alternate tax regime and has provided the following information to you. The question says that the person has a profit from specified business eligible for section 35AD, which is rupees 6 lakhs. Now, notice carefully that people, this is a profit from speculative business, specified business. Do I have a problem with this? No. I only have a problem with loss from specified business because that alone cannot be carried forward, cannot be set off against other incomes. You have to set it off only against profit from specified business. Because I only have profit from specified business, this is a normal income, can be fully taxable. Next, it says the loss from trading of equity shares is 50,000 and the loss from commodity derivatives is 75,000. Now, this is the first biggest issue. Notice carefully that the question says from trading equity shares they are getting 50 and from commodity derivatives they are getting 75,000 rupees. Now, this is ICAI's attempt to test you on speculative business. But the problem is the question is that pathetic that they have not come and clarified. For those who have done speculative business properly, the provisions of speculative business would come and say a speculative business only comes into picture when you are going to sell something without any mere delivery. Yes, without any delivery, if the transaction takes place and a trading takes place, that becomes a specified or a speculative loss. Now, notice the first one. The first one says loss from trading of equity shares of 50,000 rupees, which means this has not been clarifying whether they have done it with delivery or without delivery. When you're trading in equity shares, the assumption would be that the person would do it with delivery, and therefore this should ideally not be a speculative loss. This can be a normal business loss, is what I would say, because nothing is mentioned. The issue comes in the second one as well. For the persons who know, the question of the provisions of income tax section 43 comes and says, when you're talking about commodity derivatives will only be a speculative loss if it is not done with CTT payments, which means if a CTT has been paid on it, it is not a speculative loss. And therefore, the next biggest thing and the next biggest issue which ICA has done is to not come and clarify whether CTT was paid or not. If a CTT is paid, I would still call it a normal business loss. But if a CTT is not paid, this would be a speculative loss. Therefore, now you have a problem. I don't know what the right answer is. Yes, point number 3. Point number 3 says you have taken a loan of 40 lakh rupees from State Bank of India for purchasing an house of stamp duty of value 42 lakhs in January 2022. Yes, now here is ICA's attempt to ask you a specific section called as 80EE. 80EE spoke about the fact that if you had taken loan anywhere between 19 to 23, they would permit you to claim an additional 1.5 lakhs in your Chapter 6A as a deduction. But the problem here is that the person has taken this property and has let out the property. Yes, now this is ICA's futile attempt to come and test you on something which is ideally wrong from income tax perspective. This is something which I've already appealed to ICA in the past as well, but unfortunately they have not listened to it properly. I'll tell you what. Notice, it says the person has let out this house in February 2024 for a rent of 15,000 rupees per month. Notice it says February 2024, which is not your financial year. It is a previous financial year, which means in your financial year, this asset was there for the whole 12 months. My rent being 15,000 per month, it becomes 1,80,000. The person has paid 1,60,000 against principal, which is nothing but your ATC. Since you're opting for optional regime, you're permitted to do that. And 4,40,000 against interest during the previous year. Now, this is where ICI went a little wrong. This 4,40,000, notice carefully that the property is an LOP property. So, by the rules of LOP property, when you have any interest on loan, income tax permits you to claim the whole interest on loan in the HP chapter itself. Yes, but there is only one problem here. Notice that my taxable GAV is going to be 1,80,000. But in that 1,80,000, I don't have any municipal taxes in the question. So I am going to be granting a 30% standard deduction. My taxable income is only 1,26,000. If I attempt to put the 4,40,000 in the HP chapter itself, I will end up getting a loss of 3,14,000. Yes, now 3,14,000 worth of losses is kind of wasted, because as per the HP rules, you can only set off 2 lakhs worth of losses against other heads. And therefore, this was something which ICA attempted in 2020. In 2020, when ICA brought in this adjustment, ICA made a futile assumption to come and say, because I'm not able to completely consume my 2 lakhs worth of losses, I would rather do one thing. I would not put the whole interest on loan in LOP property, but would rather take it to Chapter 6A. Which means to the extent I can claim it in HP, I will claim it in HP. Everything else, I'll move it to Chapter 6A and I'll claim it there. Now, from an income tax perspective, are you legally permitted to do so? I would say no. This is a horrible no, because if you read section 80EE, section 80EE comes and says that you can only claim an interest under HP chapter from to Chapter 6A, provided it is not claimable under HP, which means 80EE is a subsuming section. Subsuming section means that only when you can't claim it under your HP chapter will you come and claim it under Chapter 6A. Now, what do you mean by can't claim? A can't claim can only come in a position of SOP properties, because SOP property will give you a restriction of worth 2 lakhs, and therefore anything more than 2 lakhs would be not claimable. But in an LOP property, when the HP chapter itself is giving you the claim, can you bypass that and bring in some number to Chapter 6A? The answer would be no. But ICA makes an assumption that in this case, I would then rather have to carry forward this losses to the future year, which is a waste of the income, because I would have to pay tax in the current year. And therefore, ICA makes an assumption that I can split this interest on loan into 2 different heads. Now, can you do it practically? No. That's where the whole problem comes. With the actual law speaking, I would come and say the whole 4,40,000 should be part of HP, and therefore that is my assumption. But with ICA making an assumption, ICA wants to allocate some part of the money to Chapter 6A as well in order to claim more benefits. And therefore, you now have 2 alternatives. But ideally speaking, you have 4 alternatives, because if you notice on the PGBP part of it, you're still trying to figure out whether which part of it is speculative loss and which part of it is not a speculative loss, which means you'll now have to play permutations and combinations. Let's understand this carefully. Last adjustment says loss from betting of horse races. Now, to this extent, I am fairly understood. This is not a claimable loss. Winnings is not a claimable loss, and therefore you will let go of this. Now, if I know the losses part of it, people, let me answer question number 6 first. First adjustment says loss from trading of equity shares of 50,000 they want to carry forward, or loss from betting of horse races. No, you cannot carry forward betting. Loss from trading of equity shares of 50,000 and loss from trading of commodity derivatives. This can be an option, possible option, option number B. Next, loss from trading of equity shares of 50,000 for 4 years and loss from trading of horse races for 8 years. No, you cannot claim horse races. And the fourth one says loss from only equity shares, which means you now have one thing clarified. From ICI's perspective, loss from equity shares, they have assumed it as speculative loss. By indirect means, the question itself has now come and told equity shares can only be speculative loss because that is what you're carrying forward in all the 4 options. So I am sure to one extent, my equity shares is going to be speculative loss. The problem is now on the commodity derivatives. Now the commodity derivatives can either be option B or it can be option D, depending on the case, which means I have no options but to try out both. It took me almost about 30 minutes to get to this adjustment, people. I had to do multiple things. The first option is where I have made an assumption that my commodity derivatives is not a speculative loss. If it is not a speculative loss, can I adjust it against my normal business income? Yes. If I'm doing that, my PGBP income becomes 5,25,000. In alternative number 2, I made an assumption that no, this is also a speculative loss and therefore that also cannot be adjusted, and thereby my income stands at 6 lakhs. But when it comes to HP, I have 3 different ways to do it. In option number 1, I told you what income tax asks. Income tax asks that if you are having an LOP property, whatever interest you have will be fully adjusted only in LOP. Which means in my case, what I've done is I've taken the whole 4,40,000 and my HP loss becomes 3,14,000. I don't have any chapter 6A because whatever excess I have, I will simply carry forward. This is option 1. Option 2 and 3 is what I felt very, very bad about. Here is ICI making wild assumptions. In this question, ICI has asked for GTI and TI. And therefore, they have made a wild assumption on GTI as well. They've made a wild assumption on TI as well. While the answers at the TI level may be the same, but the answers at GTI level may change. Why would it change? Let's understand. In option number 2, I am making an assumption that I'll give first priority of 1,50,000 to 80 EEA, which means I am coming and saying out of the total 4,40,000, let me make an assumption that I want to claim the whole 4,40,000, may say 1,50,000 under my chapter 6A deduction, which means my HP loss will only be 2,90,000, and therefore I am only adjusting 2,90,000 in my interest on loan, keeping the balance 1,50,000 in my 80 EEA. Option 3 is where I'm coming and saying no, let's first keep so much of money in HP which I can utilize and then put the balance in 80 EEA. Notice carefully, people, my NAV is coming as 1,26,000, which means to the extent of 1,26,000 I can set off HP loss, so that will be done. Apart from this, HP loss to the worth of 2 lakh rupees can also be taken to other heads. So which means I'm totally going to keep in my hand 2 lakhs plus 1,26,000 of HP, which means totally 3,26,000 is what I want to keep in HP, which means out of 4,40,000, 3,26,000 is what I will keep in HP, and therefore my chapter 6A gets the benefit of 1,14,000. Now, if a person notices carefully, the difference between these two is technically nothing. Whether you call it 2,90,000 and 1,50,000 or you call it 3,26,000 and 1,40,000, the answer remains the same. The answer technically remains the same, but you have to know, people, that the way of presentation will make a difference, because the more you keep in HP, the less is your GTI, and the less you keep in chapter 6A, the more is your GTI, which means your assumption can make a difference. It took me a while, people, and I had to do 3 different combination questions, which means I had to get 6 different assumptions on how the answers will approach. In my HP option 1, I am assuming 4,50,000 is part of HP, but in my PGBP, I am assuming option 1 where commodity derivatives is a speculative, and option 2 where in option 1 commodity derivatives is not speculative, and option 2 commodity derivatives is speculative. In second option, I am assuming 1,50,000 completely allocated for 80 EEA, and then again doing the PGBP combination, and option 3 is where I am coming and assuming first priority given to HP and then second priority given to 80 EEA. Notice that in my option 1, I am getting GTI is 3,25,000, 4,00,000, 1,75,000 and 2,50,000. Now, there is no better way to do this, people, other than by looking at all the options together. In this, if you notice, my GTI is coming as 4,00,000 and 3,25,000. Let's check which question has 4 lakhs worth of GTI. I do have a 4 lakhs worth of GTI and I have a 3 lakh 25 worth of GTI as well, which means both these options can match. But the problem is my total income in my question will come as 1 lakh 75 and 2 lakh 50. Notice my TI question. In my TI, I don't have any option with 1 lakh 75 and 2 lakh 50, which means this whole computation is wrong. Basically meaning ICA has not followed income tax laws. ICA wants to allocate some part of it to 80EE. That's for sure. This will not make sense. Yes, this brings me to option number 2. Option number 2, where I'm coming and saying I will allocate 1,50,000 to your chapter 6A and then allocate whatever is remaining to HP. In that logic, I get my GTI as 3,61,000 and my GTI is 4,36,000. If I notice there is no 3,61,000, no 4,36,000, which means this option is also not the right answer. That gives me option number 3. In option number 3, my GTI comes to 3,25,000 and 4 lakh, which is what we just saw is matching by bind first rule as well. And the second one shows 61,000 and 1,36,000. If I notice my question now, I do see 61,000, but I don't see 1,36,000, which means I don't have this as an alternative as well. By that logic, there is only one option remaining in the 6, which is my answer, which means my GTI should be 3,25,000, my total income should be 61,000, and by this understanding, one thing is clarified, that commodity derivatives is being treated as a normal loss, because commodity derivatives treating as a normal loss was my alternative number 1. Which means unless you do all the 6 alternatives, you can't answer any one of the 3 questions, because then you're making wild assumptions. The answer to this question by that logic would be 3,25,000 in GTI, which is option C, 61,000 in option total income, which is option A, and by that understanding, option D becomes my right answer. Yes, one of the most horrible questions I've ever seen, people, because which of the options could have been done is the same answer. Notice this one thing carefully. In my option 2 of HP and option 3 of HP, my total income is the same. There is no difference in my total income. It's all the same. The only problem is coming because of my GTI and my allocation methodology. Yes, which means can a person come and say I would still prefer to go for option 2? Yes. At the end of the day, when the total income is the same, how you allocate does not really make a difference. So I say asking a question specifically on GTI was wrong, was not good from their side. They should have not done it, and therefore I would sincerely request ICI, for this question alone, a person should be given grace marks to the extent of whatever he has attempted. At least an assumption made from your side should not hamper a student's life. You should not be questioning them for 6 marks worth of question by these kind of assumptions. This is not the way to go, ICI, is what my small thing is. Yes, if you have not attempted this question, it's all right. It's all right. I would reasonably agree to the fact that you would have not got it right. It doesn't matter, people. It's completely fine. Yes. So let's keep that one thought in mind. I think apart from this, MCQs remained very easy. I was not having any difficulties in the balance MCQs. The question number 7 was an easy amendment question, which we discussed in special Super 50 also. I told you that when it comes to your LRS scheme, when it comes to TCS, look at the question. Mr. Shivam is a resident individual and has made the following payments to ABC Limited to purchase overseas tour package. People, when it comes to TCS rules and an overseas tour package, the rule says that for the first 7 lakh rupees, you will collect TCS at the rate of 5%, and for anything balance, you will collect TCS at the rate of 20%. So in the first instance, they have taken a TCS of rupees 4 lakh, sorry, they have made a payment of rupees 4 lakh rupees, and therefore for the 4 lakh, I will do TCS at the rate of 5%, which comes to 20,000. Next, in this next 5 lakh rupees, I'll have to allocate appropriately, people. For the 3 lakh rupees, I'll do TCS at the rate of 5%, whereas for the balance 2 lakh rupees, I'll do TCS at the rate of 20%. Yes, so if I do this, I should get the answer as what? 3 lakh into 5% will give me 15,000 rupees, and 2 lakh into 20% will give me 40,000 rupees, I see. Yes, and therefore option number, this is nil, so no. This is 20,000, yes, but 1 lakh is not the answer. Option C becomes my right answer. Yes, so option C is the right answer. Fairly an easy question, people. For those who have attended classes with me, I already told you, when it comes to TDS and TCS, this time TCS was the most expected question, and a question from that level has come, so therefore no challenges here. Question number 8. It says on 18th June 2024, an unexplained money of 30 lakh rupees was deducted for Mahesh. Expenses of 10 lakh rupees was incurred to earn this income. He has also brought forward losses of 4 lakh rupees. Compute the amount of income tax payable by Mahesh. And very easy question, people. Unexplained income question. Unexplained income question simply comes and says whatever is your gross income, take the gross income, multiply by 78%, and that's the final answer. Can you claim expenses? No. Can you claim losses? No. So I simply take 30 lakh rupees and I multiply by 78%. So multiplying 30 lakh rupees with 78%, my answer comes as to 23 lakh 40,000, and therefore option A is the right answer. Yes, this one was a very easy adjustment. So therefore, I don't see a problem here. I think from this section number B starts. So therefore, yes, when it comes to MCQs, this is what it is. I think a person should have been easily been able to answer question 7 and question 8. So that is 2 marks each. And then you have your, yeah, I think this one I don't even really want to give a guess, people. Question 4, 5, 6 is a game of chance, But yes, when it comes to HP and when it comes to the residential plot, you should have got it right, which means 2 plus 2, 4, and then another 4 and 4, 8. Yes, this is what I would say out of MCQs you could have easily scored. Everything else which is coming in question number 2 would be a bonus for you. If it comes to you, great. But yes, I would sincerely request, I say, for everyone to be given grace marks for the case study question number 2, because that was not the way to go. Nevertheless, let's spend time on the descriptive part of the questions right now. Yes, let's look into the descriptive part. Let's see what is happening in the descriptive part of it. The first question is a total income question. One of the questions which I personally did not like in the current attempt, people, because while the question was not difficult, the question was definitely lengthy. It was a very, very lengthy question, because of the reason that the question said they wanted a person to compute total income of SC BOS under default tax regime as well as optional tax regime. With this, they have now requested you to compute total income under both the levels. Yes, and therefore that is where the big issue will start. But nevertheless, let's read the question. Let's see what we need to do. First, the question says there is a person called Mrs. SC Bose, age 62 years. Now, people, 62 years would mean the person is a senior citizen. But luckily, this question is asking for total income. So, unless there is a 80 TTB in this question, I don't really care about it. The question says the person is 62 years, a widow of public sector employee who's died during service in 2011. I don't think this is really relevant. She earns an income from business of running a flower bouquet shop at Kolkata and has income from royalty from writing books of science and selling in India and abroad. So the person is having some bouquet business and is also having royalty incomes from books. The profit and loss account for the year ended 31st March is given to you. Now, as much as people have done classes with me, people, there is one thing which I've already told you and always informed you. When it comes to total income question, always start from the right side. Things may go changes. Yes, the first thing I'm noticing, the first thing comes and says there is a sale of flower bouquet which is 36,75,000. Now, this is the one thing which I wanted to discuss with all of you, and the one horrible mistake which has probably happened. I am not really sure. I had an opportunity to look at all the other faculties' paper reviews as well, which people have been doing in the YouTube channels. Yes, and the one thing which people have not paid attention to, which is why I feel ICI may also lose to pay attention to, is the fact that this is now a presumptive income. Yes, notice the turnover. The turnover is only 36,75,000. With the turnover being 36,75,000, the person has a turnover less than 2 crores or 3 crores as the case may be, which means this question you should have checked for presumptive income. And the horrible issue which has happened here is the presumptive income is lower PGBP this year. Yes, which means even if you have computed the whole PGBP, if you check for presumptive, you'll notice presumptive income will report a lower income, and therefore any sane person would like to go for presumptive taxation and not go for normal computation. Yes, which means if ICI really wants to play a googly on this, you may end up losing the whole 8 marks worth of PGBP if you have not done presumptive on this. For those people who have done presumptive, amazing job. You have done a great work. But yes, based on what I've been hearing from other faculties in the video reviews, the one challenge which I'm noticing is none of the faculties are doing it, which means their total income and my total income is not going to match, people, because my total income will be as for presumptive taxation, whereas their total income will be different, and therefore there can be a line of difference. What ICI will do is something worth checking out when the answer key comes out. We will only know when the answer key comes out, so let's wait and watch until that. Next, the person has any family pension from PSU through bank. People, when it comes to family pension, there is only one rule. You can only tax it under IFOS. So I will take it out from PGBP and I'll add it to my OS sheet. Next, the person has a royalty from California University for books sold. Now, people, reading the heading, I can make two assumptions. I can either make an assumption that royalty is a part of PGBP, or I can make an assumption that royalty is part of other sources. In my assumption, I would like to make royalty as a part of IFOS, because then only I can do presumptive properly. Otherwise, I'll have to include this as a part of my presumptive income as well, which I don't want to. And therefore, I'm making an assumption this is going to IFOS. I'm taking it out of PGBP and I'm moving it to IFOS. Next, the person has received dividends, but the question says it is net of TDS. People, net of TDS really causes problems, which means I'm going to remove 4.5 lakhs from my PGBP. But when I'm adding it in my IFOS, I'm going to add 5.5 lakhs. Is it 4.5 lakhs divided by 90% will give me 5 lakh rupees. Yes, so when I'm adding it to my OS, people, I will add 5 lakh rupees in my OS because this is net of TDS. I need to gross up the number. Next, there is an interest on FDR. Luckily, this question says there is no TDS which is deducted. Because there is no TDS deducted, I have no challenges here. Whatever I report is what the number will look to. Yes, and therefore minus 76,000 is what I will reduce from PGBP, and I will add this 76,000 in my OS. Next, closing stock will remain as it is, no adjustments on that. Coming to the left side, people, opening stock, do I have an issue? No. Purchases, do I have an issue? No. Salaries and wages, do I have an issue? No. Expenses relating to books authored, people, this is expense relating to the royalty books. Because I have made an assumption that this is part of OS, I will disallow it under PGBP and claim it under IFOS. Next, expenses in connection with dividends. This is the big problem here. Notice when it comes to dividends chapter, income tax comes and says under section 57 that when it comes to dividends, expenses in connection with dividends is generally not allowable as deduction unless and until it is a interest expense which is incurred. When ICA bluntly gives something called expenses in connection with dividends, you don't know what is the right answer. I am, for the sake of convenience in my question, going to assume that this is interest expense and nothing else, and therefore I will disallow it under PGBP and I will claim it under OS. If you have made an assumption that this is not an interest expense but rather any other expense, then you can make an assumption that it will only be disallowed under PGBP and not be claimed under OS because you cannot claim that expense. You will have to write suitable assumptions here. Next, when it comes to repair and maintenance, I don't have a problem. This remains as it is. Amount paid to IIT Chennai for scientific research. Now, people, donations made to scientific research, if I'm doing alternate tax regime or optional tax regime, I will let it go. But if I'm doing DTR, then DTR it will get added, which means I will add it to PGBP only if I'm following DTR scheme. Next, computers and other electronics, people. Computers and other electronics is a purchase of a capital asset and therefore this will get disallowed under PGBP, but I will now have to claim depreciation on this. So I will disallow it under PGBP and claim depreciation. Net profit becomes my starting point. Yes, so this is my starting point. Let's look at my additional information. Additional information number 1 says purchases includes 2 lakhs relating to flowers and creepers directly purchased from a farmer in cash. People have made payment in cash on a single day of rupees 2 lakh, but the adjustment here is that the payment is made to a farmer. We already have an understanding, people. Rule 60D confirms that when you're making a payment to a farmer, the payment is allowed even in cash, and therefore this has no adjustment. The adjustment remains as it is. Next, repairs and maintenance includes one-time deposit of 2 lakh rupees which is paid to electricity and water department. Yes, I made a one-time deposit. Now, when you make a one-time deposit, people, obviously this is an investment from you. You're going to get back the money. This is not an expense from your end, and therefore this should not have been claimed as an expense. It's an accounting default, and therefore I will tax it in the PGBP, or let's say I will disallow it in PGBP. So I'll add it to my PGBP statement. Third, it says computers and other electronics which includes 1 lakh rupees paid for television and washing machines for household purposes. It says that out of the 4 lakh rupees which I purchased, out of the 4 lakh 50 which I purchased, only 3 lakh 50 was used for my business. 1 lakh was not used for my business. Now, you should have not gone wrong in this, people, is what my assumption is, but let me clarify. When you're disallowing under PGBP, people, you're disallowing the whole 4.5 lakhs. It doesn't matter whether it is for my personal reason or for my official reason. At the end of the day, it's a capital expense and therefore should be disallowed under my PGBP chapter no matter what it is. But when you're claiming depreciation, you will claim depreciation only on 3.5 lakhs at the rate of, people, it says computers and other electronic equipments, 1 December is what it is given, which means it is put to use for less than 180 days, and therefore you should have claimed depreciation at 20%. You should have claimed depreciation at 20% is what the right answer would be. Yes or no? Yes. So that is what you should have done, people. You should have disallowed the whole 4.5 lakhs under PGBP and claimed depreciation on 3.5 lakhs at the rate of 20%. Next, salaries and wages include salaries which is paid 2,40,000 to her illiterate brother. Reasonable salary is 1,40,000. People, this is a classic section 40A2 case. Section 40A2 basically comes and says when you're making payments to your relatives, you will be disallowing the excessive expenditure. So here I'm going to disallow 60,000 worth of PGBP expense. Yes. Next, it says she purchased a residential house of 1,10,000 rupees, out of which loan of 75 lakh rupees was taken from State Bank of India. The accrued interest of this is 3,37,500 rupees till 31st March 2025, which was paid on 10th April 25. No principal has been paid and interest has been paid for both till 31st March 25. People, they're coming and saying they have not paid any principal or interest for this payment. Ground floor of the house was used for shop and the first floor was used and occupied by her for residential purposes. Yes, so I am now coming and saying that for the shop I am using the ground floor and for the first floor I am using it for residence, which means people, this house now has part HP chapter and part PGBP chapter. Now, this is the next useless adjustment given by ICAI. I'll tell you why. If you notice on the top does not even have the word interest, which means one thing is clear, that whatever interest is being informed in this question is not part of my net profit statement. It is something which is out of the books. With that understanding, one thing is very clear. The out of the book adjustment, which is of my 3,37,500, now has to be split into two. This 3,37,500, if I split into two, I get the answer as 1,68,750. Now, if you notice carefully, 1,68,750 is my interest which is incurred for my house. And the next 1,68,750 is my incurred for my business. The issue here, people, is that this 1,68,750, I am fairly clear. This is a part of my HP statement and therefore will be treated as an interest on SOP loan. An interest on SOP loan, I can claim it as a deduction if I am opting for DTR. The problem comes on the PGBP part. Notice carefully, people, and this is something which I only discuss at final level because you have case laws against it. At inter level, this was not an adjustment to be tested. Notice this one part carefully, that the 1,68,750 is not an interest which is paid till 31st March. And unfortunately, this person has not booked it in his P&L as well. But the question comes and says that the person made the payment on 10th April 25. Now, for those people who know section 43B, section 43B of income tax comes and says when you have an expense, you can claim the expense as a deduction if it is made before the due date of return filing of the year. Now, return filing of the year would be 31st July or 31st October as the case may be, and therefore I would be eligible to claim this 1,68,750. But the question is, it is not showing in my P&L. Can I still claim it? Yes. As you go to CA final will come and tell, even if an expense is not booked into your P&L, but if it is made a payment before the due date of return filing, you are still permitted to claim the deduction as an expense. Here is a case where in the P&L it is not there, and therefore whether should I claim this 1,68,750 becomes a big question. As per my CA final syllabus, I would say yes, you can claim it as a deduction. Alternative number 2, I can come and say this question does not even mention that the person is following cash system of accounting or accrual system of accounting, and so to that extent I may come and say the 1,68,750 should not be claimed as a deduction, which means I don't know what the adjustment is on this. Person can make any wild adjustment and you will still be right. Which means this is the part where ICAI should give you grace marks if you have tried something. Next, the question says the person has purchased electrical vehicles on 39/20/24 for 25 lakh rupees for business purposes. If you have an electrical vehicle purchase, people, you don't have any rocket science on this. This is 39 and therefore it is more than 180 days. You can claim depreciation at the rate of 15%. The last one comes and says the person has sold 10,000 worth of listed shares of SBCL Limited for 11,66,000 on 11th December 24, which was purchased in 2,65,000 on 16/8/2024. Notice, people, I bought it in August and I sold it in December, which means asset is you hold it for less than 12 months and therefore this is an STCG under section 11(1)(a). You have 11(1)(a) worth of STCG in this case. Yes, this is what the income statement will look like. The question is saying the STD is paid and therefore it is 11(1)(a). Yes, now this is what the question looks like. The problem in this question, like I said, is twofold. One, presumptive question. Second is this interest on loan for the PGBP part of the house. I don't know what to do with this. From my understanding, people, I try to create a PGBP statement and a total income question. If my total income question, it will look like this. If I go for DTR and ATR, people, what are the differences? The first one, like I said, I'll start from net profit, and the first things I will remove all my OS incomes. My OS incomes were family pension, royalty, dividends, and interest on FDRs. I've removed those. In a claim, I'm also going to be claiming depreciation, and depreciation, like I said, I'm going to be claiming 3,50,000 worth of computers at the rate of 20% and 25 lakhs worth of electric vehicle for 15%. So I've claimed those as a depreciation. Till here, your ATR and DTR will not undergo a change. Coming to the disallowances part, the first disallowance I'll make is the 75,000, which is the expenses incurred for the books. The 12,000 of dividends, because I'm going to park it in IFOS. The IIT donations will only be disallowed under my DTR or my new tax regime, because that is where I cannot claim it as deduction. And then everything else remains the same. Computer worth of purchase, like I said, 4,50,000 will be disallowed because it's a capital expense. 2 lakhs worth of deposit will be disallowed because it's not an expense. And 60,000 worth of brother's salary will be disallowed because it is not an unreasonable expense. In my assumption right now, I have assumed 1,68,750 should not be claimed as deduction because from my perspective, that is a CA final topic. And therefore, my gut feeling is ICA in exams also, in suggested answers also, should not ideally give you 1,68,750 as a claim. If they give it to you also, people, they should give a double alternative. One alternative where you can take it, one alternative where you cannot take it. That should be given by ICA is what my feeling is. Keeping that logic in mind, my PGBP has come to 11,10,000 and 11,45,000. But like I said, this problem question has 3675 as my gross receipt, and therefore if I make an assumption that if my 3675 is completely received in non-permissible modes, I will get a presumptive at the rate of 8%, which is 2,94,000. Yes, and therefore this is where the challenge is. This 36,75,000 rupees now can either be 6% presumptive or 8% presumptive. Regardless of what you choose, presumptive is the right answer in the question because my total income in business versus my presumptive income, presumptive is showing lower. And therefore, any sane person at this point of time should go for presumptive income without offering any books or getting them audited. Without offering any books or getting them audited. This is what I would come and say. In my illustration, I have assumed 2,94,000 as the answer. Which means in my PGBP now, do I have a difference between ATR and DTR? No. The only adjustment was 35,000, which is anyway getting ignored because now you're going for presumptive taxation. Next, if I'm going and taking an HP loss, like I said, the 1,68,750 worth of HP losses can be claimed because it's an SOP property. But this can only be claimed if I'm opting for ATR. It cannot be claimed if I'm opting for DTR. And then my STCG income, people, the question came and said that I had a sale value of how much? I had a sale value of 11,66,000 minus 2,65,000. So 11,66,000. I'm sorry, 11,66,000 minus 2,65,000. I will get an income of 9,01,000. That is what my STCG is reported as. Yes, the next thing comes, people, now to go to IFOS. The first one, if I'm going to IFOS, people, what will happen? I'll take my family pension. Now, family pension rules come and say that when it comes to family pension, you're eligible for 1/3 of the family pension or 15,000 under ATR and 25,000 under DTR, whichever is lower. Luckily, in this question, 1/3 of the family pension is the right answer because 15 and 20,000, 25,000 will not really make a significant difference, and therefore my ATR and DTR remains the same. There is no difference in my ATR, no difference in my DTR. My claim is 1,20,000 rupees. Next, royalty income, I've taken 4,25,000. I'm claiming an expense of 75,000 because that is the expenses which is incurred for earning the royalty. But notice, people, this is royalty on books. 80QQB comes into picture, and 80QQB comes and says when you receive royalty in books, you can claim a deduction of rupees 3 lakhs under 80QQB. However, this is the third mistake. Notice this one says this is royalty from California University for books sold, foreign exchange brought into India. This is coming and clarifying that the foreign exchange is brought into India within 6 months. And therefore, if you are making an assumption that this means that the money has been brought within 6 months, then you can claim that as a deduction. But if you make an assumption that it is not brought within 6 months and the 3 lakhs is also not eligible as deduction, you will have to write an appropriate note against it. Notice this is only a deduction under my ATR and not under my DTR. Third, I have dividends where I am claiming 5 lakh rupees as my dividends. But like I said, I am making an assumption that the interest the expenses which is given is actually interest. By that assumption, I am able to claim 12,000 worth of deduction. If you make an assumption that that is not a deduction, then you can remove it off. And next comes your FDR interest, which is 76,000, thereby giving me a total income of 11,54,000 under my ATR and 11,54,000 under my DTR because I'm going for presumptive income. Keeping my presumptive income in mind, my income comes to 11,54,000 in ATR and 11,54,000 in DTR. Then I claim my 80QQB, thereby giving me an 18,82,50 and 23,49,000. Yes, but one second. In this question, I think I also have ATC. No, I don't have ATC, people, because the question comes and says that the principal is not repaid. The rules of ATC come and say that you can only claim ATC when a payment is actually made. There is no payment made, therefore ATC will not also come, which means technically if you look at it, the technical answer would be that there is no difference between ATR and DTR except for the 80QQB. The second difference will come of the the donation paid for IIT only when you come and assume that you're not doing presumptive taxation, and to that extent you have a certain challenge, which means if you notice, people, in this question I have made 4 different assumptions. Assumption number 1 is on the presumptive part. Assumption number 1 is on the presumptive part that I can claim presumptive taxation. This is the big assumption number 1 I'm making. This is the big assumption number 1 I'm making. Assumption number 2 I am making is on the fact that expense of dividends is nothing but interest. Assumption number 3 which I'm making is that the interest on HP loan I can claim as a deduction or cannot claim as a deduction. And assumption number 4, for the purpose of doing presumptive, I am assuming that the payments have been received in non-permissible modes. 4 different ways you have to make an assumption in order to get the answer, people, which means this answer can horribly change. A 15-mark answer can completely change off with different ways of assumption. If ICA has to put out this answer, ICA has to give you 4 different ways of computing it and 4 different answers of computing it, which means by permutation and combination logic, you can get 16 different ways to solve this question and you all will be right in all the 4 cases. Yes, imagine 16 different ways. If ICA has to give suggested answers, they will also go crazy. That is the problem sometimes, people, when you don't know how to present a question paper. When you give weird things in the wake of confusing a student, you may end up horribly making the paper wrong. There is no intention of doing all those things in exam is what my feeling is. This was not expected from ICA at this point of time. But yes, the paper was manageable to an extent because I assume every student has made certain amount of assumptions and has written the answer. Have you made wrong assumptions? No. My only request is, if you have made the assumption and if you have written the assumption in the paper, ICI should really give you marks for those assumptions, no matter how weirdly and widely it is, because the problem is with the questions, not with your thought process. Question number 1, every person should get 15 marks if you have made right assumptions here. Yes, that is my sincere request which is coming up to ICI. Let's see how the suggested answers goes before we make a choice on this. Next. 20 minutes it took me just to explain this, people. Imagine you have to solve this question in 14 minutes. I think after this, the paper was fairly easy. There was no difficulties in the paper. So let's look at the other questions very quickly. The first one says the person has to state with reasons whether the income is chargeable to tax in India for the assessment year 25-26 in respect of the following independent situations. First, Mr. Mahesh has received dividend of 7 lakh rupees declared and paid by a foreign company outside India. Such dividend has been declared in respect of shares which he derives value substantially from an asset located in India. He is a ROR. Sorry, he's an RNOR. People, an RNOR rule comes and says it is only taxable if it is 4 incomes: income received in India, income deemed to receive in India, income accruing and arising in India, deemed to accrue and arise in India, and income accruing and arising outside India from a business controlled from India, profession set up in India. This is the dividend income. Now, dividend income, if you notice, the money is declared for an asset outside India. The money is declared for an asset outside India, and the money has also been paid somewhere outside India. Yes, which means the money is not accrued in India, the money is neither received in India, and therefore this answer is not taxable. Now, ICA did try to confuse you people by coming and saying that the shares are substantially deriving its value from assets located in India. This is actually a final level topic. In final level, you will notice that in final level, they'll tell you that when it comes to section 9, section 9 has a clarification. The clarification says that when you say substantially deriving values, that is only for capital gains and not for dividend income. And so dividend income will still be ignored for that matter. This was a final level topic. You should probably not have made too much of an assumption. Not taxable is the right answer. Second, Mr. Shivnash is a non-resident in India and is residing in China, has deposited 16 lakh rupees with ABC Limited, an Indian company, on 1st September 24. He has received interest at the rate of 12% per annum in China during previous year 24-25. A non-resident has received interest income for a loan which is given to a resident. People, we have discussed about this, that when a money is received from a resident, a normal assumption is that the resident is going to use this money for Indian operations. If he's going to use it for Indian operations, this income will become taxable for the non-resident. Yes, next, Mr. Ramesh has received royalty of 8,25,000 in consideration for providing patent rights to Mr. Sunil. Mr. Sunil has developed a new product in India by utilizing the patent rights. 30% of the royalty was received in India and 70% was received outside India. Mr. Ramesh and Suresh both have a status of non-resident. A non-resident has received royalty from another non-resident. But notice that the royalty is used for patent rights in India. Because the royalty is used for patent rights in India, the business and operations have taken place in India, or the sources of income is in India, and therefore this also becomes taxable. This also becomes taxable, which means the answer to this question: 1 non-taxable, taxable, and taxable. Then looking at the tedious part of the question. Question number 1 says Mark Pictures Limited is a movie and a short films production house having turnover of 15.22 crores during the previous year 23-24. Your turnover is more than 1 crore, hijacker rules will apply. Solar Varanasi LLP also produces short films and clippings, and it has already produced a short film, namely Mahakumbh. On 16/10/2024, Mark Pictures has acquired television rights in consideration of 52 lakhs from Solar Varanasi LLP. Both have a valid PAN. People, this is a case law in section 194C. If you have noticed in your books, you would have read it in section 194C. 194C basically comes and says that when you're going and buying advertising and telecasting rights, or if you're buying any kind of products from from a producer or a short films. From a producer or short films, there are two ways to look at it. One, if the product is specifically made as per your requirements, then 194C will apply. But if the product is not made specifically as per your requirements, but is made as a ready-made product, then 194C will not apply. Therefore, 194C will not apply. So I would say no TDS under section 194C. This is what the answer would be. Now, option alternate number 2. I can also make an assumption that because the payment is worth 52 lakhs, this is a purchase of a good, and therefore 194Q can apply. And therefore 194Q can apply because the value has gone beyond 50 lakh rupees. You can have a TDS under section 194Q at the rate of 0.1% on the number exceeding 50 lakhs, which is the 2 lakh rupees. This is an assumption which can be made. Unfortunately, ICAI has never given a clarification on this, and therefore there is no right answer to this. If you have written no 194C, my expectation is ICAI should give you full marks. Next, Mr. Mayank is a salaried individual and has paid rent for his residential house at Mumbai to the house owner, Mr. Nikhil, in the following manner. The person is making payments. This is section 194 IB, people. Section 194 IB comes and says that when you're making a payment to a person exceeding 50,000 rupees per month, you will have to deduct TDS at the rate of 5% up to October and 2% after October. Yes, in this case, I am making a payment from April to September of 75,000 rupees and October to March 1 lakh rupees. People, 194 IB also comes and says that the whole TDS will be deducted in the last month of payment, which means I will not worry about the 5% rule. I will worry only about the 2% rule. In the 2% rule, I will now have to figure out how many rent I have made. April, May, June, July, August, September. So 6 months I am doing 75,000 and 6 months I am doing 1 lakh rupee. Yes, so therefore it is 75,000 into 6 plus 6 lakh rupees for the next 6 months. My total rent which I am paying is 75,000 into 6 plus another 6 lakh rupees. I am getting 10 lakh 50,000. In this 10 lakh 50,000, my TDS will be at the rate of 2%, which means my TDS value is 21,000. Yes, so 21,000 is the total TDS which I should have deducted on the last month payment of the month of March. So on the month of March, I should not make a payment of 1 lakh rupees to the person whose own is this, to the house owner, Mr. Nikhil. I should have not made a payment of 1 lakh rupees to Mr. Nikhil. I should make a payment of 1 lakh minus 21,000 to Nikhil. Not a tough question, people, fairly an easy question. Look at the next one. I am looking at the next question, the 6th mark question. It says, Mr. Sandeep is a manager in CTL Private Limited at Mumbai and has furnished you the following information. The person has a basic salary of rupees 55,000 per month and entitled to a commission of 2,500 rupees per month. So I have a basic salary of 55,000. My commission is 2,500 per month, which is nothing but fixed commission. A company owned accommodation is provided to him in Mumbai, where furniture is also provided, 2,40,000. Now people, I have given you an RFA. RFA rule comes and says that when you are going to give a house owned accommodation by the company, then you will get a 10% of salary as a taxable component because the house is in Mumbai. But since I've also provided furniture costing 2,40,000, I'll add an extra 10% on the cost of the asset. Yes, so 24,000 worth of furniture will be taxable and 10% of my salary will be taxable. Now, I'm not telling you what the salary is right now because I need to know what the salary definition is. As per current practice, salary definition will be basic salary plus the commission, but let's look if the question has some more adjustment as well. Next. The person has also taken a personal loan of 3 lakh rupees on 1st September, on which interest at the rate of 7.75% per annum was charged by the company. The entire loan is still outstanding and the SBI rate of interest is 12.75. People, this one is an easy adjustment. Concessional loan rule comes and says that if you have a loan taken from an employer, whatever is the concessional interest will be fully taxable as a component perquisite. So therefore, 12.75 is my SBI rate of interest minus 7.75 is my taxable interest, and therefore 5% is my concessional loan. Now 5% has been received on 3 lakh rupees. Yes, and therefore my total interest comes to 15,000. But notice carefully, this 15,000 is for the whole year. The loan has only been taken from September. And can I take it for the whole year? No. I will take it from September. So September, October, November, December, Jan, Feb and March. So which means this will be multiplied for 7 by 12, which means my taxable interest is 8,750 rupees. Yes, so 8,750 rupees is what I'm going to be taxing as perquisite. Now, will this 8,750 be considered for my RFA computation? The answer is no. So I'm going to ignore it. Next, Mr. Sandeep is the owner of a house property in Kolkata which he constructed during financial year 16-17. The property consists of 4 identical units. People, we're shifting gears right now. We are going into house property chapter, which means from a salary perspective, I think this is what the question is. In a salary perspective, what exactly is my income statement right now? My basic salary will be 55,000 into 12. My commission will be 2,500 into 12. For the purpose of RFA, now I know the numbers. My RFA numbers will be 55,000 into 12 plus 2,500 into 12 into 10%. My furniture will be 2,40,000 into 10%. and then my concessional loan will be 8,750. I can take all these things, and then I need to decide whether I'm doing alternate or default. Yes, the person is opting out of default regime, which means he's going for alternate regime. So I'll give a standard deduction of 50,000 rupees in order to arrive at my income from salaries. Yes, so remove 50,000 rupees, income from salaries will be reported to you. Let's look at the HP part of the question. The HP part of the question is coming and saying the person is occupying 1 unit for his residence. So therefore there is an SOP, and the 3 units was let out at a rent of 20,000 rupees per month per unit. So I have 30,000 rupees, 20,000 rupees per month per unit. So which means 60,000 rupees I'm getting per month for all the 3 units put together. Into 12 will give me, how much is this? 60,000 into 12 will give me 7,20,000. So 7,20,000 is my GAB. The municipal value is given as net 9 lakh rupees. People, 7,20,000 or 9 lakh, whichever is higher, and therefore my actual GAB will become 9 lakh rupees. My GAB will become 9 lakh rupees, and the municipal tax is 20% of the municipal value, which means I can reduce 1,80,000 in this. Yes, so 9 lakh rupees minus 1,80,000 will be my net annual value. Oh, one second. They've given you fair rent and standard rent as well. So wait. Let's compute the whole thing properly once again. People, my municipal value is 9 lakh rupees. My fair rent is given as 7,50,000 rupees, whichever is higher, therefore 9 lakh rupees. Standard rent is 8,50,000, whichever is lower, therefore 8,50,000 is the right answer. So my expected rent is 8,50,000. Yes, let's check what my actual rent is. My actual rent is 20,000 into 3 into 12, and therefore I get 7,20,000. So my actual rent is 7.2 lakhs. People, whichever is higher, and therefore my GAV becomes 8.5 lakhs right now. My GAV becomes 8.5 lakhs. The question says one of the let out units was vacant for 6 months during the year. People, is this relevant? Answer is no. Unfortunately, in this question, because my GAV is as per expected rent and not as per actual rent, can you claim vacancy loss? No. No vacancy loss will be permitted in this question because my actual rent is lesser than my expected rent. You are not a good assessee, and therefore no vacancy loss to you. Interest on loan taken for construction of the house is 2 lakh rupees. Can I claim it as deduction? Very well. No problems here. And therefore, what is my NAV, people? If my GAV is 8.5 minus 1.8. So 8,50,000 minus 1,80,000 will give me 6,70,000. Reduce 30% standard deduction. I get 4,69,000. My interest is 2 lakh rupees. Fully allowed as deduction because this is an LOP property. No. One second. This is not an LOP property, people. This. Oh. Okay, I'm so sorry. I think this answer is wrong. Let's do this once again, people. My mistake. I'm so sorry. This is my mistake. Let's. I forgot to pay attention to the first one. Notice carefully, people. The question says the property has 4 identical units, which means whatever values are given to you, the municipal value, the fair rent, the standard rents are given for the whole house, whereas the actual rent is given only for the let out piece, and therefore we'll have to allocate it accordingly. Wait. So therefore, municipal value or fair rent, whichever is higher, therefore 9 lakh rupees. Standard rent is 8,50,000, whichever is lower, and therefore my expected rent is 8,50,000 for the whole house. But wait, 8,50,000 for the whole house, I have to do into 3 by 4, which means my expected rent is actually 6,37,000. Now the question makes sense. So my expected rent is 6,37,500 rupees. My actual rent, we just found out, is 7.5 lakhs. No, 7,20,000, I think. 60,000 into 12 is 7,20,000. Yes. So I have an actual rent of 7,20,000, which means, people, now my GAV is showing as 7,20,000. But now I am a good assessee. Because my actual rent is more than my expected rent, I am permitted to claim my vacancy loss. The vacancy loss question comes and says one of the let out units was vacant for 6 months during the year, which means I have a vacancy loss for 20,000 into 6, which is nothing but 1,20,000, which means my NAV is now 6 lakh rupees. With my NAV being 6 lakh rupees, I can now claim a 30% standard deduction, which means 1,80,000, and then claim my interest on loan. In my interest on loan, people, interest on loan, again, if you notice, 2 lakh rupees is given to you, but the 2 lakh rupees is for 4 units. I only want the LOP part. So 2 lakhs into 3 divided by 4 will give me the interest for the LOP part, which is 1,50,000. Yes, if I check this out, my 6 lakhs minus 1,80,000 minus 1,50,000 gives me 2,70,000. Yes, so 2,70,000 is my income taxable for LOP property, but because I have an SOP, I can claim an SOP loss. The person is opting for ATR and therefore you're permitted for an SOP loss as well. Therefore 1,50,000 worth, 50,000 worth of interest will also be claimed as a further deduction, thereby giving me the taxable income as 2,20,000 for HP. Yes, so my HP income will be 2,20,000. My salaries we already discussed, people. Yes, it's not a very complex question if you read the questions properly. Yes, I made a mistake of not reading the let out piece once again, and therefore that's where I went wrong. But if a person has done it properly, this question was fairly easy. You should have been able to answer this question very, very easily. Next, you're discussing the taxability with reasons in the hands of recipients for 25-26 on the following receipts. The first one says Ram has received a sum of 5 lakh rupees from his father on Ram's wedding anniversary. Now, for those people who have made a mistake here, you have to pay attention. The second part of it comes and says it is Ram's wedding anniversary. So therefore, is it taxable? Yes. But notice the payment is coming from father. Yes, while your wedding rules may not have been satisfied, your relative rules have been satisfied. Because the payment is received from a father, it is not taxable as a gift. It is not taxable as a gift. This will become exempt from taxes. Next, Mr. Govind sold his property to Mrs. Radha for 1 crore 25 lakhs, whereas the value determined by the stamp duty authorities is 1 crore 75 lakhs. Now, people, if I take the immobile property rule come and says that the sale value, the gift element should be more than 50,000 rupees. It clearly is 50 lakh rupees here, and therefore that is satisfied. But let's take 110% of the consideration also. If I take 125,000,000 into 110 percentage, I get the answer as 1,375,000, which means I am still not satisfying the 110% criteria, which means this is taxable. Yes, so this is taxable to the extent of 50 lakh rupees. 50 lakh rupees will become taxable in point number 2. Next one, Mrs. Augusta got a gift of a car worth 7 lakh rupees from a friend for a wedding anniversary. People, it's a car, and therefore this is not taxable. This is not a specified asset. This is not a specified asset. Yes or no? Yes or no? Yes. Which means question number 3 was fairly an easy question. You could have definitely solved it. In an order of priority, I would say question number 3 should have been picked up. But let's see question number 4 also, people. Let's see what the last question entails to. Question says Mr. Sanju is an individual assessee aged 32 years and has furnished the following details. There is a loss from future and options. People, loss from F&O is not a speculative transaction. This is a normal business loss. Yes, so this is a normal business loss and can be claimed as a deduction. So a normal business loss I will claim as deduction. Next, I have a profit from a restaurant business. Can I set off 75,000 against 2,21,000? Yes. So there will be 2,21,000 minus 75,000 worth of PGBP income. Next, share of profit in a partnership firm where the person has 19% share. People, this is ignore. Understand this carefully. A profit from the partnership firm is exempt from taxes. Next, income from salary computed, fully taxable component. Interest on loan paid for self-occupied property is 1,75,000, where principal amount paid is 1,20,000. People, 1,75,000 can be set off against salary income. Principal prepayment will become 80C. But wait, let's check the question. The question says if the person is shifting out of default regime. Yes, the person is shifting out of default regime, therefore my rules will apply. HP loss will get set off against salaries. 50,000 ATC will be granted for 1,20,000. Short-term capital gains fully taxable. Long-term capital gains 112A fully taxable. Long-term capital loss 112. People, if I have an LTCL, I can set off only against long-term capital gains, and therefore I will not tax 1,10,000 right now. I will tax 1,10,000 minus 68,000. Yes. Next, his wife is receiving a salary of 2,40,000 from a partnership firm Excel. People, I think Excel is the same company. Yes, the same company has been mentioned here. Next, where she is an accountant. She does not have any professional qualification. People, they try to test you on clubbing provisions here. Notice carefully, the person is a wife. The spouse has been receiving salary from the partnership firm in which the person has some interest. And the wife is also not professionally qualified. Now, for those people who have ended up giving this as a clubbing rules, the answer is wrong. This will get ignored. Tell me, why is it getting ignored? Because the hint is here, people. The question comes and says the share is only 19%. Notice the clubbing rules. Clubbing rules only apply when there is a substantial interest. Substantial interest requires you to have 20% holding. Because this is 19% holding, the person who is the owner, whoever the person is, Sanju does not have a substantial interest in the partnership firm, which means this salary will be taxable in the hands of the wife. It will not be taxed in the hands of Sanju, and therefore this should have been ignored for the purpose of Sanju's tax computation. Yes, this is one good adjustment which I think you may have gone wrong. But if you've got it right, thumbs up. Next, he paid 21,000 for medical insurance premium 80D. Yes, so I'm getting 80D here, 21,000 for medical insurance. 80D is what my computation will be. And then I have 9,000 rupees for preventive health checkup. I can claim 5,000 rupees out of it. Yes, so therefore I have 21,000 plus 5,000 becoming 26,000, but because I am not a senior citizen, I am 32 years, this 26,000 will get restricted to 25,000. So 25,000 worth of 80D I can claim. Brought forward speculative losses 26,000 people. Is it relevant? No, I don't have any speculative incomes here, so therefore this will get carried forward. Yes, this being the third year, and therefore you have carry forward for one more year. Next, brought forward short-term capital losses 52,000. People, short-term capital loss can I claim? Yes, this is the fourth year. I have eligibility till 8 years, which means my short-term capital gains, I don't need to pay tax. I don't need to pay tax. I can take the short-term capital loss and I can reduce it from the 82,000 fully. Yes, so I can reduce it from the 82,000 fully, which means my taxable short-term capital gains will become only 30,000 rupees. Will become only 30,000 rupees. Compute the total income of Sanju. See, the question is only asking for Sanju, not for the wife, which means that information has to be ignored. Also state the losses to be eligible to be carried forward. People, there are two losses which I'll be carrying forward. One is the no, actually there's only one loss to be carried forward, right? This loss of speculative loss alone will be carried forward. The speculative loss alone will be carried forward. No other losses will be carried forward because futures and options can be treated as a normal business income, business loss, normal business loss. Yes, this is a fairly easy question, people. While yes, you may have gone wrong in point number 9, but other than that, I think you should have fairly got this question right. Which means out of 6, if you have done 9 alone as wrong, you may probably get 5 or 4, which means still not a wrong question. Next, state the persons who are required to apply for the allotment of PAN under 139(1)(a). Mention the time limit for making the application. Theoretical question, people. Or specify all the documents which is required for quoting, in which quoting of Aadhaar number is mandatory under 139AA. Also explain the provisions to him. 139AA does not apply. People, this was an out of the box question. I definitely was not expecting these theory questions because these are all redundant provisions. I really would have not paid attention to it, but nevertheless, the provisions of the first one will come and say you have to apply between 31st May. You have to apply by 31st May, or you will have to apply as soon as you're getting a new bank account where you're making a withdrawal more than 20 lakhs and so on and so forth. Yes, so a theory question was given there. For the next one, it comes and says, what are the cases where you will not apply Aadhaar card? Aadhaar card will not be applied if you're a non-resident, if you're not a citizen of India, if you're residing in Jammu and Kashmir. That's all the cases. That is all the cases. In that case, you need not get an Aadhaar card. Yes, which means question number 4, I would have not read for my exams. Yes, most of the students would have ignored this point question, and therefore, if to that extent, if you come and ask me, I would probably say the questions which you should have attempted is question number 2 and 3. Yes, you should have attempted question number 2 and 3 and then gone for compulsory question number 1 and then gone for compulsory question number 1. You should have scored more marks in that compared to question number 4. Yes, unless and until you can come and tell me that TDS was ignored from your side. If TDS was ignored from your side, I would then prefer question number 4 also. There is no problem because then question number 2A and 4 fairly were easier to each other. Yes, while question number 2A you would have spent lesser time because you just had to mention taxable or non-taxable. So I would have still preferred question number 2A. Yes, great. This is what your income tax paper looks like. Now, completing the whole paper, people, one thing is fairly clear. In the paper, things were manageable. Adjustments were good. Adjustments were easy. The only problem with this paper is there is various assumptions to be made. There is a lot of adjustments, lot of assumptions being made, various combinations can apply. And therefore, for this paper alone, there is one small thing which I would request to ICI, and if this video reaches ICI, then I'll be very, very happy about it. But one small request which I'll make to ICI is, if you're making such wild assumptions, please give marks to students for writing that assumption. Any assumptions made by the student should be treated as a valid assumption, and therefore you should be granting them appropriate marks to it. Please do not consequently fail a student because they have not made the assumption you are preferring for. I would sincerely request that the suggested answers this time comes with all the combination adjustments which we just discussed. Not even one adjustment has been skipped over because the student definitely does deserve. A vague question like this should be deserving for its marks as long as student attempts. I am not denying the fact that because it was vague, if a student has let go on of the question paper, then definitely no marks for him. But if a question has been attempted by the student in all the practical sense, you should be giving them marks is what my small request is from ICI. Yes, my gut feeling, keeping this in mind, keeping GST in mind, getting 40 is definitely not a challenge. You can easily score 40 in this paper, people, because yes, you were able to score 8 marks worth of MCQs. You can easily score question number 3 and question number 2 to the best extent possible. So 10 marks here and 16 marks there automatically becomes 16. Compulsory question, if you have attempted also, probably at least 5 marks can be easily awarded. Yes, so 21 comes there, 21 plus 8, you have almost reached 30 marks here itself. GST, this time with the easiness which came in GST, I think you should be able to score at least 10 to 15. If you're able to score 20, 25 also, then already the paper is cleared. Yes, which means every person who has written this paper, please be assured that you should be definitely deserving to clear the paper appropriately. So yes, please don't worry about what has happened. This is all I wanted to tell in today's video. Thank you everyone for watching this video. I know it's been 1 hour 15 minutes. I had to take that much time, but yes, it took me lesser time as compared to what you'll write. The paper was definitely lengthy. I'm not going to dispute that fact. It was a lengthy paper for two reasons. One, you will have to make so much guesses, so much assumptions, and therefore to that extent you will definitely have to spend more time. But other than that, yes, I had to spend this much time on this paper, people, because I knew every single adjustment had a different trick and logic which I wanted you all to keep in mind. How much is everyone expecting out of this paper is not something which I want to know. Please do not mention any comments writing, sir, I'm suggesting this much marks, I'm thinking about this much marks. If you think that I have not done this adjustment, how many marks am I going to lose? Please don't do that, people. I really don't care, and I request you also to stop worrying about it. At this point of time, your paper is already done. If you have let gone of an adjustment, how much marks you lose is something which you and I both cannot decide. It is not something which ICI also decides, because it's on the examiner's mood. While ICI may give a recommendation to the examiner is free to make whatever wild guesses he wants for your marks, and therefore it is not worth it to come and ask how much marks you're going to lose. Focus not on what you're going to lose, focus more on what you're going to get. Try to evaluate how much you're going to get, and if that comes to the best extent possible as more than 40, 45, 50, you're safe. You're safe. If it is coming anywhere below that, maybe this is the time for you to come and kickstart your studies a little earlier than what your results will look like. Yes, that is one small thing which I wanted to tell you all. For everyone who's writing September 25 and Jan 26, a good paper for you to analyze and realize that yes, ICI can go horribly wrong when it comes to multiple things. So please be careful on how you read the books. If you're preparing books just by mugging up the provisions without using your logics to it, there are multiple places where you can go wrong. This paper is a very good example of that. So please start reading the subject conceptually, because you will require it from your exam perspective. All the very best for your preparations, people. If you have any doubts, feel free to drop in your words in the comments, and I'll try my level best to answer all those questions to you. Until the next video, I hope you all have a great learning ahead. Thank you everyone. Have a nice day.